In this video, you'll be learning about this topic.
So, guys, let's move to the second topic here of today and talk about cyclicality. We did have the pleasure of speaking with Howard Marks about his book, Mastering the Market Cycle, here on the show, and he emphasized the two rules of cyclicality. Rule number one, most things will prove to be cyclical. And rule number two, some of the greatest opportunities for gains and losses come when other people forget about rule number one. So, starting with you, Wes, how have you made or lost money in the market because of neglecting them, or perhaps from having a deep understanding of cyclicality?
I would first question the premise a little bit in the sense that, you're going to have a lot of survivor bias in claiming there's cycles because that implies something came back. But what about like all the other things that literally went to zero and blew up and you don't read about anymore, right? So cycles clearly didn't work there. But, if you're a survivor, cycles are always going to be amazing because just keep buying the U.S. equity market. You're a genius. You get to earn the 7-8% equity return premium. But, go ask all the other countries where on average you earn like 2% and you get your face ripped off most of the time. So I would say I just question the premise of that in the first place. And then obviously all my wins go exactly in line with what he's talking about in the value realm, where you buy something that's totally out of favor, total piece of junk, and it makes money. But who cares about that? I would say the cycles that I screwed up the most are actually the opposite of that, momentum cycles, where I can think of three examples of recent memory. One is in real estate. So my brother lives in Eagle, Colorado, where I grew up. It's in the mountains. And probably 2012, we had all these opportunities to buy different real estate properties out there. But of course, being value cheap bastard, we're like, nah, it's too high, man. Don't want to get in. Of course, we didn't realize that's a momentum trade. And, it's only quadrupled with leverage and we'd be millionaires right now. And of course, most recently here, March 2020, me being a genius, I'm like, this is the greatest time ever to buy value. I'm going to do that. And yeah, that kind of worked. But guess what? Should have bought momentum because it would have worked 10 times better, right? So for me, all the cycles that I look back that I missed, value guys always talk about cycles and then point to value wins, but they're not highlighting that the big wins are the momentum cycles that we all miss. So I think that's an important thing for kind of value people to think about it is momentum cycles, not mean reversion cycles. What do you guys think?
Yeah, I think that's a great point, Wes. When you think about like that real estate example you used in Colorado, that local market might have been at some inflection point where the true value was dramatically understated for whatever reason. And whether it's people moving to the area or, home prices appreciating or whatever it was. But, I think about like Google as an example in the stock market. You could look back and I think Google did 20 billion in revenue in 2008 when the last real lengthy recession occurred before this past one. But, the advertising market that year contracted 10%. Google's revenue slowed. It was growing at 50% before the recession. It still grew through that period. I think their revenue grew 8 or 10% in 2009, which was a significant advertising downturn. And it was just the fact that Google was such a small piece of the advertising pie at that point. They had 21 billion in revenue or something. The advertising market was 400 billion. So they had a 5% share of a big market. And they had a value proposition that was very clear cut. And it was clear that they were going to be much, much bigger. And so, those are businesses that are able to withstand the cyclical nature of the economy. And I think all businesses are cyclical to a certain extent, some more than others. But the other way to think about cyclical businesses or the risk that you're talking about, the risk of investing in something that's cyclical, is to think about the business itself within that industry. So I'll use home building as an example. All home builders are cyclical because the nature of real estate is cyclical. And so that implies some sort of risk to a typical home builder because most home builders have an enormous amount of inventory on their books. And what happens in a downturn is home sales slow, land prices often decline. And so home builders are left with a huge amount of inventory on their balance sheets that have to be marked down. And a lot of that inventory is financed with debt. And so the balance sheets are often very risky. But within that industry, there's a company called NVR. And I've spoken about this company before. And it's a stock that my fund owns. But it's a very cyclical business, just like all the other home builders, but with one key difference. And that's that the balance sheet is much lighter. They carry far less inventory than most of the other home builders. And so what that means is their inventory turnover is much faster. They have about 1.5 billion in inventory, and they turn that inventory about every 2.5 months. Lennar is the biggest builder in the country. They did about 22 billion in revenue last year. They have 18 billion in inventory, and they turn that inventory about once every year. So NVR's turning its inventory 5 times faster. Lennar did about 3 billion in profits on 18 billion in inventory, and NVR did $1 billion in profits on 1.5 billion in inventory. So basically, what that's telling you is NVR's return on capital is about 5 times higher, and so it's just a better business, is another way of saying it. But it's got a variable cost structure, and it's much less risky when the downturn comes. They tie up their land using options, which is that's how they're able to do it. They don't put as much capital into the ground. They put a down payment on the land, and if trouble comes, then they're able to walk away and just lose the option premium, just like a call option on a stock.
John, just push back, because I was talking about more like sentiment cycles. Mm-hmm. I mean, arguably, these guys are positioned extremely poorly for a sentiment cycle they may be missing, right? Because wouldn't you want to own the super operating leverage, maxed out, whoop it on home builder versus the nimble, low inventory, super fit one? Because if you can borrow for negative rates and there's a sentiment cycle, like I would argue you actually are taking a huge cycle risk betting against the sentiment cycle by not buying the other one you mentioned. That's the problem.
Yeah, exactly. And so the problem for most builders is they can't get away from exactly the situation you're talking about. So it's 2 things. One is the inflation in land prices that happens over time. So in theory, you're much better off owning land if land prices are appreciating at 2% a year, because the nature of your slow turnover, the one benefit of slow turnover is that land, as it's on your books, is going to be worth more when it leaves your books than the price that you paid for it a year ago. So that is true. The problem is, and again, this is why builders can't seem to replicate NVR's model. The problem is, one of it is incentives. All the builders, if you read the proxy statements, almost all the management teams are incentivized to produce absolute profits. And so the best way to produce absolute profits, not necessarily return on capital, just make more money. The easiest way to do that, just like Buffett says, the easiest way to make a savings account earn more money is just add more money to the savings account. So builders are incentivized to just go out and buy more land, regardless of the returns that they can generate on that land, because they'll know that even if they earn 15% gross margins instead of 20, they're going to be compensated for that at the end of the year, because they can use other people's money, the bank's money, to go out and buy more land. So it's the inflation aspect of it, and the incentive structure makes it very difficult for any other builder to copy NVR. But you're exactly right that NVR is on the losing end of it in an inflationary environment or in a big boom. And we're sort of experiencing that right now in housing, which housing's in a boom right now. Part of it's COVID fueled, and part of it, the housing market's been in a bull market for a number of years now. But yes, NVR earns smaller profits relative to what it could if it put the land on its balance sheet. But the benefit is, when the next downturn comes, and it's inevitable in housing, NVR is just going to be much safer. They're much better positioned to survive any sort of downturn. And most of these builders are going to be fine. They're going to survive fine. A lot of the builders have tried to slowly try to work towards a more asset-light model. But again, none of them have been able to replicate what NVR has in terms of returns on capital. But they're all trying to go that direction to de-risk their balance sheets.
It's just a slight philosophical difference, right? There's one approach to investing where you say, I'm going to try and maximize the amount of return that I can take per unit of risk that I take, which I think there's only 2 sort of sensible ways of doing this. I'm going to maximize the amount of return I can take per amount of risk that I can take, or I'm going to try to not take any risk at all. And I know that there's no way in the world you're investing in the markets at all, not taking any risk. I'm going to look for situations where there is some return still available there. And I'm going to try and only hit on those things. I think John's sort of more in that. He'd just rather not take any of the known risks that if there's a way that you can lose money, he's just not going to do it.
You have to be careful because, like we said at the top of this call, knowing what you don't know, there's all kinds of uncertainty out there. But I do believe that when you think about surprises, it just seems this is just an empirical observation. I don't have data on this, but good surprises tend to happen more often to good companies, and bad surprises just tend to happen more often to bad companies. And so I'm not in the game of trying to predict these cycles. I understand that business is cyclical. And so for me, I think Charlie Munger has this quote, sometimes the tide's with you, sometimes it's against you. And we just focused on trying to keep swimming forward. And that's kind of my view on it, is sometimes the wind's going to be at my back and sometimes it's going to be a headwind. But I'm going to try to focus on investing in companies for the long run that I think, have staying power and that are good businesses that I have a feeling that earning power is going to be higher in 5 years than it is now, for example. I want to invest in those types of companies versus the real cyclical companies that have a huge amount of risk and much more volatility to their business. So I tend to avoid those types of companies. It's not that you're not taking risk, because all companies have certain amounts of risk and things can change, which goes to my point earlier on you want to invest in companies that are adaptable to change. Stig and I talked about Facebook once. I mean, that's a company that I think has proven its ability to adapt to changing environments. That's a business that's very difficult to predict 10 years out. It's hard to know what that world is going to look like in 10 years, but the management team to this point, and this is not guaranteed, there's no guarantee that this will be the case forever, but to this point, I think they've done a good job at shifting and recognizing business risks that they faced, as opposed to just putting their head in the sand and ignoring it. I think they've been very genuine about their desire to fix issues. I think they've had a lot of foresight in risks that their businesses face and maybe is facing right now, and they've adapted to those changes. So that's the other thing to think about, is you want to, again, for my style of stock picking, I want to invest in companies that I think can adapt to those changes and can, have some sort of staying power through these cycles that will inevitably occur from time to time.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.